Good morning and welcome to the Homestead CPA. My name's Dan Snyder. I was fortunate last year to be invited to the Okie Homestead Festival to talk about accounting, tax, and legal issues for homesteaders. Apparently, I didn't do too poor of a job because they've invited me back again this year. Last year, we covered a wide range of topics. In fact, there were so many questions that I ended up doing a 15-part video series, which is available on here that you can go look at, that covered a wide number of topics. These topics are relevant for any business, not just homesteaders, but it's something that if you have questions, you can look at any of the videos. You don't have to watch all of them. You can just pick the one that you're interested in and see if that can help. But after the presentation last year, I sat around and answered questions for about 3.5 hours, and I'll probably end up doing so again this year, and I'm happy to do so. But I noticed that there were a number of very common questions that came up. And so this year, I decided that I would cover these very specific tax issues that were raised in hopes that it might answer a number of people's questions and give everybody a good basis for doing some tax planning for 2025. Now, I'm going to say up front that we have a new government in place that is trying to pass new tax legislation. And so anything that I say may be changed. So be sure and talk to your tax advisor about this before you actually implement anything that we talk about today. So with that, I want to cover 3 specific items that you can use to help minimize your taxes and maximize your tax refunds for 2025. The first has to do with what we call an accounting method. So individuals are on a cash basis, and we talked about that briefly last year. What that means is that if I buy a chicken from you, I hand you $20 and you sell me a chicken, you have income. You have it because you've received the $20, or I hand you a check, you have received the money, or I pay you by credit card or Zelle or Venmo or however I'm paying you. The minute I pay you, you have income. The reverse is true. If you're buying feed from me for your chickens, then the minute you hand me cash or a check or pay by credit card, you get a tax deduction for that payment. You don't get a tax deduction when you later pay your credit card bill. You get it the moment that you actually use the credit card. So if I buy feed in December and I pay my bill in January, the tax deduction is in December, not in January. So as you might imagine, this gives us opportunities for planning. Now, typically in tax planning, our typical goal is to defer income, put that income off till next year, and accelerate expenses. In other words, take more deductions this year, defer income to next year. Why? Because we don't want to pay as much tax. But sometimes we might want to, or even need to, flip that script on its head. Maybe next year we know we're going to have a large amount of income. So we might want to accelerate some income and take extra income this year to try and help minimize the problem next year. And the same thing is true for expenses. If we have the opportunity to take an expense this year, but we know we're going to have a high level of income next year because there's some one-off event perhaps that we're going to have, well, we might not want to buy that this year. We might want to put that off until January if we can. So what are some typical planning things that we can do? I'll give you an example. We were in a position where we wanted to buy another heifer calf and we wanted to sell 2 steers. Now, this was towards the end of 2024, and cattle of all sorts were expensive. So we knew we would get good money for the steers. We also knew that buying a heifer was going to cost good money. So what did we do? Well, we ended up buying that heifer in December so that we could take a tax deduction for her. And then we waited and we sold those steers January the 4th, 2025, so that we recognized our income this year rather than last year. So we used the money basically for the from the steers to pay for the heifer, or one of them anyway, and the rest was we wanted to recognize our income from claiming the steer. But had we been intending or know of a large income event, we might have flipped that around. We may have sold the steers in December and purchased the heifer in January, but that was just the way it worked best for us. Planning for these things is why you need a good advisor who can help you make these plans. They need to be aware of your situation. You need to talk to them. They can't read your minds. So talk to them and they can help you do that. I gave the example last year. The typical one is, well, should I buy a new whatever, truck, tractor, what have you? And the answer is, well, it depends. Do we need the deduction this year? Do we want it next year? So cash method is a way that you recognize your income and your expenses and utilizing that to your advantage. So if I had chickens, maybe if I needed more deductions this year, I could buy 3 months worth of feed instead of buying 6 weeks at a time. Maybe I could buy a piece of equipment that I don't necessarily need now, but I know I'm going to need it in March or April when the springtime hits. So things like that, planning like that, will allow you to control your expenses for the year. The other main item like that is depreciation on capital assets. So what's a capital asset? It's something that lasts more than 12 months. So once again, it goes back to, should I buy a tractor? Should I buy a new truck? Well, all of these things give rise to what's called depreciation. It's a deduction basically for the cost of that item over a period of time. You have choices that you can make. The general rule, you can take it over a period of time on a declining balance basis, which means you take more up front and less at the end. You could elect straight line, which means you take an equal amount over each year in question. Or you might choose to take 179 deduction or bonus, which will allow you to deduct some or all of the cost in the year you buy the equipment. So all of these things can be done and can be used to best control and manage your income tax. Because the second thing that came up, and I found this over and over and over again, people kept wanting to get their income down to zero. They didn't want to have, they thought, well, the best way, the best answer from a tax perspective is to show zero taxable income. Well, the reality is that's not true. Why? It's not true because in the United States, we have two main refundable credits. That means you get the money back whether you paid any money or not. And those are refundable credits or child credits and what's called the earned income credit. So child credits are available for children generally up to the age of 16, and there's a limited credit for children that are over 16. In 2024, that credit was $2,000 per child. In 2025, assuming the rules aren't changed, it'll only be $1,000. But then there's also a credit called the Earned Income Credit. The Earned Income Credit is a credit that's payable to taxpayers who show an amount of income that shows they're trying to make money, they're trying to earn a living, but they just haven't quite been successful. Now, what I mean by trying, if you don't make enough money, then the IRS thinks you're not trying hard enough, so you don't get as much of a credit. If you make too much money, then they think, well, you don't really need the help, so you don't get the credit. The sweet spot for a married couple with 3 children is taxable income of around $25,000. So if your income is around $25,000, the refund that you would get after accounting for all of your taxes, income taxes and self-employment taxes, will be at its highest. So less than 25, you're going to get less of a refund. More than 25, you're going to get less of a refund. Now remember, this is a refund of refundable credits. I'm not talking about any taxes that you may have had withheld from maybe an outside job or something to that effect. Those are separate and apart from this conversation. You would get that money back as well. So having said that, you can see how if I can control the timing of my deductions, I can get closer to that $25,000 mark than I might have if I didn't do any planning. And that can be a significant difference. It can be a $3,000 to $5,000 difference in the amount of your refund. So you definitely want to do that. And as a result, you really don't want to have zero income because you're leaving money on the table. The last thing that came up, probably at least a third of the people I spoke to, has to do with one of the ways that you can use to manage that cost and reduce your income. So let's say that you're a married couple with 3 children, and we've done everything that we can, and currently it looks like your taxable income is going to be about $40,000. What could we do to reduce that down to the 25 that we discussed earlier? Well, we've already looked at capital equipment and taking a depreciation deduction, and we don't really see any help there. We've accelerated any deductions that we could, so we don't really see any help there. So then we have to start thinking a little bit outside the box. And so one of the deductions that you're entitled to take is if you pay for labor, people who come to work for you. And that common question is, can I pay my children for work in the farm, in the business? And so the short answer is yes. The much longer answer is yes, but it must be reasonable and it must be comparable. In other words, you are not going to pay your 5-year-old $500 an hour for a 100-hour work week every day of the year. That's too much money per hour, and it's too many hours per week. So I can already hear you're going to say, well, Dan, well, how much can I pay them? Honestly, you already know the answer to that question. If a 5-year-old is working and you're holding him to it and he's actually working, then he's probably, at least initially, not going to be worth any more than minimum wage. So you're going to pay him $7.25 an hour or whatever minimum wage is in your state. Now, how many hours? Most states have hours limiting the amount of time that a child can work, even for a family business, depending upon their age. So you definitely don't want to go over any state legal limitations for hours worked by children of a particular age. Finally, you want to not forget that children learn things and they get better. So last year, when your 7-year-old had learned to milk a cow and you were paying him minimum wage for doing that, this year, your child knows how to milk a cow. So if you were to hire somebody who had experience of milking a cow, you're probably not going to pay them minimum wage. You're probably going to pay them something more. So in other words, remember, your children are probably entitled to raises because their actual productivity has improved, has increased. So that's one way to increase it, is by increasing their wage because now they have more experience. But also, as they get older, in reality, they are likely working more on the farm. And so you can pay them more per hour and for more hours. So, and I'm just going to say this for example, let's assume that we had triplets and they were all 11 years old. They all had the same level of experience and they all worked exactly the same amount. It may be that we could pay each of those children $5,000 for their work during the year, and so thereby reduce our taxable income from $40,000 down to $25,000, that sort of target number that we're looking for. The way we pay them makes a difference. If we treat the child as an independent contractor and we give them a 1099 at the end of the year, which we can do, we get a tax deduction, income tax deduction for that payment. However, the child will then file a tax return because the child is going to be required to pay not income tax, because all income is tax-free up to, in 2024, $14,600. But because it's over $400, they would have to pay self-employment tax, which is at the same rate as what you were paying, that same roughly 14% flat rate on their income. So what is the net effect of that? The net effect of that of the family is, yes, I've reduced my income for income tax purposes, but that may have only been at 10 or 12%. I also want to reduce my income for self-employment tax purposes. Is there a way I can do that? The answer to that is a very clear yes. And the way that you do that is by paying your child as an employee, not as an independent contractor. Now, what that means is at the end of the year, you're going to have to pay that child and give them a Form W-2. In addition, because they're an employee, normally you would be required to file Form 941 on a quarterly basis and report their wages to the IRS. However, lucky for you, there is a special exception to that rule for agricultural workers. And instead of filing a Form 941 4 times a year, you can file Form 943 once a year at the end of the year, basically at the same time you're filing your Form W-2. So, question is, how much is your accountant going to charge you for that? Well, let's stop and think about, well, what are we saving? If I save 12% income tax and 14% self-employment tax, and I'm just going to round that off to 25% on $15,000, I've just saved $3,700 thereabouts in taxes. So what's that worth to me? If you got to pay your accountant an extra $400 or $500, seems like a pretty good bargain, doesn't it? And that may also pay for his consulting time to figure out what the correct amounts are. So yes, you can pay your children. How you pay them makes a difference. But remember, when you pay them, it needs to be a reasonable amount per hour, and it needs to be a reasonable number of hours. So by doing this and having this conversation, it's not an all or one. You don't have to pay them exactly $5,000. You might pay one child 2, another child 4, another child 8. What are the other benefits that might come from paying your children wages? Well, one of the amazing benefits is if your children have wages, that means they have earned income, which means they are now eligible to make contributions to a Roth IRA in their own right. So imagine this, you have your children putting money away in a non-taxable account. It can earn money tax-free, and ultimately when they take it out, they will never have they'll never have paid any taxes on that income. And unlike you putting money in a Roth IRA, you actually get a tax deduction. So it's the only example I can think of where you get a taxable deduction for a contribution to a retirement plan. And when you take the money out, nobody ever has to pay any tax. So this is an extremely powerful tool that you should consider. Now, I can already anticipate all of you parents out there are going, that's really great, Dan. I can't afford to pay my kids that money. Do I have to pay them? Or can we just say I paid them? Or can I write them a check and then take the money back? All right. So here's where we get into there has to be an element of substance on what you do. And you're definitely going to need to talk to your tax advisor about this, because each one is going to be comfortable with different aspects of this, and you need to find out what they're comfortable with. As a general rule, if we make a payment in one calendar year, then anything we do to address that, first of all, needs to be in a different calendar year, and second of all, needs to generally be in excess of 30 days. So what do I mean by that? Well, let's say you pay your children and you don't put the money into a Roth IRA. Money's sitting in a bank account because you need that money back to pay bills in January. Well, if you take that money back 31 days later and your child loans you the money, then arguably it is legitimate. And so you've justified this by, hey, made a loan. You could argue that the child made a gift to you, but now we're starting to look like we're playing games with the system. The other thing that you can consider is that sometimes those little angels of yours have guardian angels, and we call those guardian angels grandparents. It may be that grandma and grandpa might be interested in helping your children develop a good saving habits, but also an opportunity to have income in a retirement plan. So they may be interested in or willing to help fund some of those payments. Maybe not all of it, maybe some of it. So you might want to have a conversation with grandma and grandpa about how they can really valuably help their grandkids. And hopefully that can lead to some good results for you. Remember, when we're planning our taxes, we want to pay what's right, but we don't want to pay any more than that. Because remember, even Jesus paid taxes. Thanks.